hold on. We've got some incredible reports related to multifamily, commercial real estate, and the economy today on the Gray Report that you cannot miss. Yeah, we're going to be talking about the election. We're going to be talking about CPI that just came out, but we're also going to be talking about a report from Newmark that really hits the nail on the head and underscores the opportunity in multifamily today. We had record numbers of supply coming online in the third quarter, but what beat that out? It was the amount of demand. Vacancy actually decreased slightly in the third quarter, setting up an incredibly opportunistic environment, especially if you can pick off some multifamily deals still at discounted prices as treasuries remain elevated. But not only do we have the Newmark report, we're going to be talking about a Cushman and Wakefield piece, the top trends across Cushman and Wakefield's multifamily portfolios, some seasonal cooldowns, a very healthy renter pool. From Fannie Mae, Fed cuts rates in second consecutive meeting as manufacturing and service surveys diverge. Oh, yeah, the Fed dropped Fed funds last week. What do you know? And then from the National Association of Home Builders, a rate cut from the Fed. What will the terminal rate be? Question everybody wants to know. And then from RealPage, a little bit of perspective on the 50-year peak in apartment supply volumes. They paint an incredibly interesting picture of what it was like in America the last time we saw this amount of record supply. But if you're a multifamily investor, active, passive, you're an operator, you're a property manager, you're in the right spot. On this YouTube show and podcast, we break down all the latest research reports, data points, and throw out some original opinions related to the multifamily industry, commercial real estate, housing, and the macroeconomy. So you're not going to want to miss a second of this. Subscribe to the Great Capital YouTube channel. Stick around for the full episode. Like and comment. Let's get into it. Welcome back to the Gray Report. Joined again by Matt Bosnagel, Director of Communications and Marketing here at Great Capital.
Hey, welcome back.
Thanks, Matt. Did a great job holding down the fort with Addison last week on the report.
You missed a lot. I don't know. Have you been keeping up?
No. Did anything happen last week?
Nah. Well, there's a couple of things. One more major than the other, I think. So we foregrounded the Fed. I know a lot of people are talking about this election now, so I'm gonna have to read up on it a little bit.
That was last week.
Yeah, I know.
A lot of people are saying, Matt, that podcasts really kind of push the envelope. This election season, which I think is fascinating. I mean, just as an effect, like the Kennedy Nixon first televised debate back in the 60s.
True.
But it's changed the landscape. And
medium is the message.
It is, and I think it's interesting. These longer form formats, where you really get to know somebody, get to really get into their thoughts and get to know them as a person. And the fact that Donald Trump went on, Joe Rogan's and Theo Vaughn and all these other podcasts, and Kamala Harris didn't. A lot of people are saying that wasn't the only reason, obviously, but certainly helped him, did not help her. And, it's podcasts like The Gray Report that seem to be, moving the needle, and it's what's attracting the listeners.
We're among them, right?
I don't want to say that we sway the election one way or the other. I can't say one. Well, I can't say one way or the other.
And Kamala didn't go on our podcast.
I know. We extended the invite. We ended up not being able to see eye to eye on terms.
Yeah.
Anyway, but there was an election. It's going to be fascinating, and it'll probably be sprinkled throughout this episode because it does affect the economy and real estate and just kind of the general direction. But from a macro standpoint, then we can get into some of the reports. And CPI just came out, and we had the Federal Reserve, lower the Fed funds rate last week, widely anticipated. We talked about what we think what's going to happen, maybe next month and, next couple months.
We were talking a little bit before the show about one of the things that I discussed with Addison was like this accelerated bonus depreciation. Yeah. As like this is a tax advantage for owning commercial real estate. And it lets you pay less taxes, essentially. And I was talking to you, and I was thinking, Trump is a real estate guy. He's going to want to save that tax money. He's going to maybe, because it was being phased out, right? That was the plan.
Yeah, it was sunsetting. Yeah.
And I was thinking, well, maybe Trump's not going to phase it out. And then you were telling me, and I was not informed, but that phase out was actually part of something that passed in the Trump administration.
Yeah, it was part of the original Tax and Jobs Act that passed, I think, in 2017, that bonus accelerated depreciation with sunset. It was 100% bonus depreciation, and then in 2023 it went down to 80, and then 2024 went down even more, and so it was going to sunset and go away. But now the talk is that'll be renewed, and it will actually go back to 100%.
Yep.
And what that essentially means, it allows commercial real estate, it allows owners of capital to take more depreciation, more paper losses to offset income that a property or an asset may produce. Now, there's depreciation recapture, but it essentially it effectively lowers your taxable rate on a lot of the cash flows generated from the property. So you're paying lower taxes. It's not as always straightforward as, you're just never paying tax on that income. You certainly do have to pay at some point, but just at a lower rate.
Okay.
But I think, people are talking about, policy specifics and plans, and I think all that will come into shape. I think it's like super nebulous right now. I don't think we really know whether it's on, focusing on tariffs or tax policy.
Yeah, like deregulation is such a nebulous concept too.
Right. I mean, apparently, Vivek Ramaswamy and Elon Musk are coming in, creating a new, sort of quasi-government organization about government efficiency. That sounds exciting. Like, I'm kind of skeptical of that, but that sounds exciting if that happens. All that, it all sounds fine, but what is more important is the psychology. We talk about this a lot, what's driving the economy, driving inflation. Yeah, the fundamentals matter, but it's how people feel about those fundamentals in the reality.
How business leaders.
Exactly. Yeah. It changes people's decisions based on what your mindset is. And if you had a negative mindset on the economy because you didn't like who was in the White House, but now your team is in charge, you probably have a more positive or optimistic vision of the future, and you start taking actions accordingly. And so, it's a true example of, a collective, kind of willing something or conditions into existence. Now, at some point, it has to be backed up by fundamentals. But that, I think, is what drove some of the economic growth during the last Trump administration. And I'm not saying it's right or wrong or it's backed on anything that, this policy is going to work, but I think that enough people want it to work that there is going to be a little bit of a lift. Now, can that be inflationary? Possibly. That's going to be the big difference between the last of Trump administration, low inflationary period, concerns were deflation until the pandemic occurred. But now we're in an environment that is kind of higher growth, where we've been dancing with inflation and a possibility for inflation to rear its head again, which would certainly be a risk that the Trump administration is, they've been focused on. Now they're going to have to focus on avoiding it.
We'll really find out.
Put the blame somewhere else.
Yeah, we'll really find out whether how much of the previous inflation was COVID related. It's like supply chains and stuff like that, and well,
most economists are still pointing to supply. And I'm not just talking about supply of goods. That certainly was a part of it. It's supply of goods, but it's also the supply of debt. It's supply of money. I think we all know that you put that much money into the system, in how it affects the business cycle, it leads to malinvestment and in prices to start getting kind of away from us.
Well, and that's one thing that I was talking about with Addison is I distinctly remember during that 2018 run up in the Fed funds rate, Trump made no qualms about saying let's keep interest rates down. I specifically remember there was all these news articles about Trump's not allowed to complain about interest rates, and he was doing that in 2018. I think he's going to do it again. Yeah.
Oh yeah. Well, that was the big kind of thing that happened at the press conference with Jerome Powell. So he got asked a question that if Donald Trump wants Jerome Powell to step down and wants him to resign, will you? And Jerome Powell, very emphatically said no. And then he asked,
I love this job.
But it was very calculated.
Yeah.
The responses, because then the question was legally, do you have to? And he's like, no. Yeah, because they already looked into it. They looked into the last administration, and so I think there'll be some probably sparring, back and forth, because I think if Trump sees an opportunity for Trump's need or rates he thinks should come down, he's going to push that because he's going to see that it could be potentially beneficial to the economy, or people at least be excited about it. And conversely, I don't see them saying rates should stay up, but I think the Fed can easily be a scapegoat for economic policy or the economy going the wrong way.
Yeah.
Either way, which I mean, they are largely default for creating, dislocations in the business cycle and oversupplying market with dollars or debt.
Yeah, we will. It will be super interesting to see because they listen to sentiment of the Fed. Listen, whether from whatever reason, like they're also tracking like inflation expectations and stuff like that, and we'll have to see whether the sentiment of a specific person matters as much as the aggregate consumer sentiments that they're tracking. But my thought is maybe inflation, maybe the real thing that's going to be the lever, perhaps more than employment. Employment seems relatively stable. If anything, it's maybe ticking down a little bit, but inflation is going to.
But it's not falling off a cliff.
Yeah, so the discussion during the election season was inflation. So I still think it's worth following, if not for the fact that it's going to be a huge topic.
Let's see where inflation is. Let's look at the latest CPI print that came out this morning from the Bureau of Labor and Statistics. Basically unchanged, man. I mean, get us into the details.
Yeah.
Not a whole lot's different from last month. And
So all items CPI, the growth was 2.6% year over year, which was the expected amount, but also is a slight increase over the previous month, which was 2.4%. However, the monthly change for October was the same as the previous month, so that kind of eases my concern. I think it's still okay to think that CPI measured inflation is going to continue to gradually decrease, but like this is the bump in the bumpy road. I don't want to be yelled at because there is a bump, because there has been in before, and once if we get several months of this, if the next couple of months have continued increases in inflation, then maybe it's worrying. But right now, I'm not going to it's not going to ruin my day that it when increased. And
I'm just glad it's not going to ruin your day.
Yeah, I know. Sorry.
I was worried about your day.
Got kind of shaken up.
Matt, did you hear any reports of people talking about the price of eggs, affected their decision in the election?
See,
and I kept thinking about how many episodes where you brought up the damn price of eggs.
Well, that's funny because I was talking to Addison last week about I had this theory that there's how in endangered species there's a charismatic species, which is this polar bears or pandas, where it represents the idea of endangered species. I think that there is a charismatic inflation indicator, and that's eggs. I just think about all I got to do is think about the price of eggs, and that gets my blood boiling.
But it's an egg should be pretty cheap.
Yeah.
You have an expensive egg is.
Yeah. But core CPI is at 3.3% year over year, same as it was last month. And rents, this is what I wanted to really get to. Rents are actually going down. So we're at 4.6.
But are they going down enough?
No, not enough. No. We're not equal to, I'm sorry, the rent inflation is going down. I'm sorry. They're by no means decreasing. And
the rate of growth.
Yeah, the rate of growth is still well above the market rate. So the rate of growth is 4.6% year over year, which is high. Previous month, though, was 5%. So, wow, we're really getting down there. Shelter is relatively flat.
I mean,
didn't change.
We're getting down there, except,
national
that's shelter,
rents. Sorry, yeah.
The national rents have been, kind of negative for the last 2
years. Exactly.
And I think it's interesting, it's gone from, shelter's 12 to 18 month lag to it's maybe it's a couple of year lag. We don't really know.
Yeah, rents especially it does.
Soft science.
And that's what I know exactly. The dismal sciences, I think. It's funny too because last week I was talking to Addison, and my whole take is this past year has been this year where things have been going so much slower than we thought. And I used this example of the recent PwC ULI report.
Yeah.
So last year's report was a new era comes into view, and now it's we're in the new era
coming into view.
Yeah. It's it took so long. It's just taking so long.
Well, it's we mentioned on the podcast before, the pandemic compressed time because we had so much years of economic activity take place.
Yeah.
Within a quarter or within a year, and now it's time is being stretched out into. It's taking much longer than we want or think that maybe it should, whether that's for, shelter to show up and see no CPI or, rates to kind of come down or inflation to come down or employment to normalize. It's just taking longer than everybody wanted it to. for prices to come down, for markets to correct. I mean, it was last October, Matt, that the first real wave of loan maturities were, beginning to come due. Those got extended, the can got kicked down the road, which we got an incredible research report that's coming out very shortly on that. But it's all been stretched out, for a variety of reasons that are deliberate and some just circumstantial.
And part of that report and part of the discussion in some of the articles that we'll cover here in just a little bit is how the Fed funds rate and arguably, I think, 10-year treasuries too, they're not going to come down anytime quick in 2025. We still may be,
Well, they came down and they came back up.
Just for 10,
Just,
so it's not
have fun on the roller coaster.
It's still there.
And I would say this report that it's going to be published like very soon, like in the next week, I think, or so. To get a head start on getting a copy, go to greatcapitalllc.com
/report
right now. But also, I'm saying you can sign up for the newsletter and you'll get sent. You'll be on the list.
Oh yeah, totally. You will get that if you go to the newsletter.
Greatreport.com, greatcapitalllc.com, somewhere like that. Just go to Great Capital, give us your email address, and we'll send it to you.
But we're going to put report as the landing page.
Yes, report. But the last one that we put out was incredible. It got picked up by like tons of major news outlets. That was a report that Grant Cardone gave us a call and wanted us to talk to him about it. So check it out because it's got some really good information. I want to talk about this Newmark report.
Let's do it.
Because not that there isn't more stuff to talk about CPI, but it's kind of isn't. This Newmark report, I came over to Matt as we were reviewing. We were going to talk about today, and I was like, Matt, this is so bullish. Yeah, this is incredible. If you are a multifamily investor, or if you're on the fence, whether now is like a good time to maybe think about getting into the market. The numbers kind of speak for themselves, and it's shocking. What I'm talking about specifically is third quarter. As the third quarter of 2024, annual demand exceeded new supply in 48 of the top 50 U.S. markets. This represents the fourth consecutive quarter in which at least 47 of the top 50 markets saw demand outpace supply. Now, that would be a good thing, but what's incredible about it is that the supply we're basically at a 50-year peak. A total of 162,000 units were delivered in the third quarter, and the demand though was 192,000. Both of these numbers are just blowing records out of the water, and we would expect, if like there was normal demand, we would see vacancy increase because of how many new units were being brought online. But there's so much demand for housing that they're all getting absorbed. And again, it begs the question of when supply starts to recede, because we see starts really falling off. It's probably going to be latter half 25 and 2026 until we see like meaningful slowdowns of deliveries. Maybe mid 2025, but it's not. And again, this comes back to it's not going to happen right away. We're talking about next year. This time next year. Assuming that demand is anywhere close to where it is today, we're back in the same position of kind of have a housing crisis. We do have a housing crisis, and we're going to see rents start to pick up considerably.
And I'll go over this in our discussion of this Real Page article later. But man, we still need new houses, and the amount of building that we did was only 2 years. And those 2 years of building didn't. They put a measurable dent in apartment demand specifically, but the housing
brought
supply
rents down for the last 2 years. Makes sense.
But that was super temporary and more temporary than you would think.
So it's a marathon. It's a marathon. It's not a sprint. We need to continue to build adequate supply of housing. We can't not build for 8 years and we just build a ton for 2.5 years and we stop and think that the problem's solved.
Yeah. And it's almost baked in that this supply is going to go down because starts and permits have gone down precipitously. And, following starts and permits, the completions fall down. So there's lots of factors that also, that would suggest higher housing demand in general. One of which is the fact that home prices are just kind of skyrocketing. Now, you have this graph up here about, economic trends favoring renting over home ownership. This is one of my like pet topics, is this difference between renting and home ownership. And it is a like a thesis that has been brought up multiple times about like do high home prices really make renters stay renters? Now, I think they do, but I haven't found, I've been searching for one, a really robust study of, how much do home prices, by what percentage of price increases equates to what percentage of rental demand. You know what I mean? So, and that's probably a really hard, short of, in Cushman Wakefield do this.
Other than we're just seeing the results of it. We would be nice to quantify specifically of like, all right, because home prices are X, that gives more, Y to more demand. But the reality is, and here's the statistic, year over year, the spread between home ownership and rental costs increased. It was already high, increased an additional 7.6%, reaching $1,203 in the third quarter of 24. Elevated by record high interest rates, renting remains notably the more cost effective than home ownership. When we see this divergence starting in the kind of Q3 of 2021, it's always been kind of a relatively tight spread between renting and owning. It was more of like, what's your preference? How long do you want to stay there? Do you have the down payment? And then it was like, well, yeah, if you're going to stay there for a while, it's much more cost effective to just buy something.
Yeah.
But now you really can't say that. I mean, renting is cheap compared. So our other housing options.
I'm glad you have this chart up here too. And there was a Freddie Mac report this week that kind of has an interesting counterpoint to this divergence. And they're saying that, yes, while affordability relative to renting is very poor compared to pre-pandemic levels, it is similar to the early 2000s within the upper range of historical norms. You see in this chart, the early 2000s had rents diverging. But what happened after that was the great financial crisis and the housing crisis. So that kind of like gave me pause a little bit.
Well, I think that's what everyone and you also know just rents. They declined a little bit here. You're correct, during the great financial crisis before they started moving up again. But it's what are the recipes that would cause for a decline in single family home prices, and the cause for the decline, like the catalyst, has already happened, and is rising interest rates and affordability. But it's not materializing. People are just locked into those mortgages, and without the demand, consensus from economists, certainly not always right, housing experts, is that there's just nothing in the fundamentals that would point to a decline in single family homes, especially if interest rates are going to decline somewhat. Maybe we may not have as easy of housing policies in the Trump administration that we could have had in a Harris administration related to, first-time home buying tax credits. But that's probably a good thing, because we didn't. That would just make houses more expensive.
Yeah.
But again, what's the factor?
Housing supply, right? There's less housing supply now than there was in the early 2000s, and so I think that's probably a huge factor.
Yeah.
And part of what drove the lower supply levels that we have right now was the result of post-financial crisis. So, we're kind of inheriting all these historical things. So the history's not going to repeat itself because we kind of created those conditions to begin with.
Here's just another statistic and graph. And new mortgages, Matt, are 53% greater than in-place rents. That's a lot.
Yeah, that's part of what I was thinking of when I was
not including the down payment.
When I was like putting myself in the mind of I used to be a renter too, and like my heuristic or whatever is like I'm going to compare my rent cost to what an average mortgage would be, and like you factor that in, and then maybe like the down payment, right? So if you can afford the down payment and that and the monthly mortgage makes sense, then you'd think that you'd become a homeowner. I think that most people would. So the interest rates are acting like such a big preventer of people getting into to become homeowners, and I don't think that's going to stop anytime soon. I do think it does have a material effect on keeping renters maintaining. If anything, this divergence between home costs and rental costs is a cushion, and it's going to lead to it's like there's like an implied stability of the rental market because of that difference.
Yeah, well, because if assuming that there is some relative equilibrium between home prices and rents, if the home prices don't come down to meet rental prices, that means the rental prices need to rise to get into some sort of range with home prices.
Yeah.
It's one of the two. I guess it could be a little bit of both, but right now.
And that's why, like, you'd think that if there was this super tight correlation between rental demand and home prices, that they'd be more in line. But the fact that there's this divergence means that there's something out of whack. I think it's because people aren't moving out.
I think, and very few homeowners are moving out because they've locked in low mortgage rates. And then also, baby boomers, they don't want to, they'd much rather age in place. Their S&P 500 is a record, it's at 6,000 right now.
Yeah.
Today. And so they've got more retirement savings than they ever thought that they would have.
And now
why would I move into the retirement home if I've got my place? I may have 3 extra bedrooms, but that's fine.
Yeah, totally. And not the least, this, I think this was a Kamala proposal, but she was talking about like expanding at home, like home care services. So, that was in the election. That's part of what people are thinking about. Maybe they do want to, like age in place. On page 7, there's this graph that shows this like razor thin gap between existing homes, the price of existing homes and new homes. It's almost reminds me of like the used car market during the pandemic, how like
that's a good
used
point.
Cars were practically as expensive as new cars. And looks like that's what kind of we're seeing in the home market.
Slow inventory. Yeah. And the home builders are, trying to, there are new homes, they're trying to move. There's not a whole lot of like existing homes. I mean, you think about if like where we live, Matt in Indianapolis, we kind of live in, similar kind of midtown Indianapolis area. There are very few, if any, new homes. It's all existing homes.
Location,
and people want to be in that location, and there's not that many options. It's like there's a couple, maybe a fair few houses on the market, so there's very few low inventory. Prices get bid up, and so all of a sudden you're buying a house that was built in like the 20s, 30s, 40s, 50s, 60s. You're paying a pretty penny, but you can go up to Westfield, get a brand new home that a builder just delivered. They're going to give you, and they're going to incentivize you on your interest rate. They're probably going to subsidize your rate, and they're probably going to give maybe some, decent pricing because they've got a decent amount of volume to move. Now, it's still going to be like elevated pricing. But, they're definitely trying to move inventory, and they're using incentives to do that.
That's really interesting. Yeah, but that's what I was thinking too, is like location. Like, there's no room. There's no room to build, and that's where it is a premium for a lot of these in specific locations. But but man, I haven't seen it that tight.
Yeah.
It's
a good point about comparing to used car sales.
Yeah. Well, and I just think it's super interesting. I don't know if you want to move on to the following reports, but I just like the whole upshot to this Newmark report was maybe relatively subdued investor interest, because this was a capital markets report. Talked about investment activity, sales activity maybe increased like 9.8%. But like this is seemingly the calm before the storm. The fundamentals are moving forward, and I don't think it's going to take very long for investors to take interest.
I think investors were taking. I mean, we talked about especially folks were getting back in the market, and folks are back in the market. But then I think everyone's pumped the brakes a little bit just because of treasuries. And I mean, the 10-year went from like 3.5 to now we're back to like 4.4, and so that's almost 100 basis, 80, 90 basis point swing. That significantly changes what your performance is going to look like and what you can offer. So and that that lined up perfectly with, the prior month rates had come down, so all the sellers were like, "Great, we're reverting back to 2021 pricing." And so every seller, every broker, every seller raised their pricing expectations because at a 3.5, 10-year treasury, you can get all of a sudden deals start to look pretty good. And so they come out with their guidance and their pricing, and they're not going to come off it. They're going to see what they can get because. And this is where the needle has to be thread, and it is full of opportunity, but there's also opportunities for danger. Is great time to get in the market. But if you overpay, you're really speculating that you're going to see some growth sooner rather than later in the big crux of it when that growth takes place. And I don't think anybody really knows. You've heard us say a lot, end of 25, early 2026. could be earlier in 2025. It could be later in 2026. You know, if you're needing some sort of growth to happen and you pay up as you're saying, well, these rents are low and rates are going to come down. That all could be true. But if you need that to happen in a year or 2 years and it ends up happening in 3 years, you've overpaid.
Yeah.
Because you've lost out on that year of growth, a year of cash flow, and every investment is compounding. You're growing off of last year's numbers and progress. So you lose out on a year, you know, so if you're like, we're going to stretch it, we think we can get to a 15-year IRR, or even less, but we're going to have to pay up to get the asset, well, you know, you're going to have a very subpar return profile if you overpay in this environment.
Yeah.
So, but if you can get a great deal, because we're on the precipice of some great growth, but you have to position yourself the right way.
Yeah. So you've been in the trenches basically, you know, for the past few years. 2023, we were waiting for prices to come down.
Yeah.
They didn't. 2024, we waited so long, and they still started to come down. Is it normally the case where, it takes a whole lot for prices to come down, but man, they can come right up at the drop of a hat?
Well, you know, I mean, they can. I think the prices did come down. I mean, prices came down.
Yeah. I'm just saying that they go down gradually in the past 2 years, but maybe they'll shoot up a lot more quickly.
I think that there's some people will want them to, and there may be some deals that trade at elevated prices, but I don't think it's going to be necessarily the whole market. Okay. I think especially what the market is wrestling with is if we are going to see an environment of a slightly higher rate environment, if we're going to have the 10-year settle out at 3.75 to 4 versus 3.25 or so, that's a big difference because if you're thinking about the spread between treasuries and cap rates. Are we at a 4.5? Are we in a 4.5 cap environment? Or are we at a 5.5 cap environment?
Yeah.
Are we at a 5 to 6 cap environment? Those are deals make sense or don't make sense, and people are either breaking even, making money, or losing money at those different definitions. And you don't want to buy at a 4.5 cap if you're going to be selling into a 5.5, 6 cap environment. If you're also speculating a lot of growth that may or may not happen in a way. Again, I think that if you overpay right now, I'm not saying that you're going to lose. You're not going to probably lose money on the investment.
Yep.
You may not make as much money as you could if you were a little bit more discerning on assets you go into.
That makes sense. That totally makes sense. We're like, it's hard to shake this feeling that we are on this midst of a turnaround. And of course, that PwC ULI report did say like the time has come for a turnaround, for an upturn or whatever. It's going to be slow. Like this is a Cadillac turning around. It's never going to turn.
It's never going to be clear as day.
Yeah.
And just go and watch all of our last episodes, the last 6 months, and you can kind of get a good. Or I mean, no one's got who's got the time to do this, but I mean, listen to the last year. I mean, you can hear and listen and see the change of sentiment of what we've been reporting on, and that shift has been going from a shift down when we're talking about, look, here's the dangers out there, prices are going to decline. Whether it's a loan maturity wall or whatever. Well, prices did decline 20 to 30%.
And that's what I keep thinking about. Like, yes, like snapshots, this kind of the same 2023, 2024 in so many ways, but also in like super important ways, it's different. And looking at those differences is really going to help you.
We're climbing a hill, we're going down the hill.
Yeah.
And when you're kind of at the top, you're not really sure. It kind of seems flat, but we're starting to slide down the hill a little bit. But just there could be bumps along the way. So kind of relatively confident on the general direction that we're going. It's just again that time scale. It's a good lesson not to try to think that you've got that part figured out.
Yeah.
So that's where I see folks.
But that that's one of the things I think about commercial real estate, multifamily is like it operates on these longer time scales, and it's a good reminder to for patience and to follow these multiple sources and really don't expect anything dramatic without really good evidence for it.
Good point. All right, Cushman Wakefield had top friends across their multifamily portfolio. This is interesting.
So this one looks at renter activity a little bit more closely as a complement to the kind of more broader report from Newmark and its focus on capital markets more. It does posit that that thesis of rent cuts driving renters to reconsider home ownership. I won't get into that again, only just to say, like, I think that this probably is the best way to track it in the graph that they have here. I think they had a survey where they asked the question to their renters, like, are you moving out to buy a home? And so they track that every month.
And I'm sure, again, when mortgage rates, when the 10-year treasury dipped down for a minute, everyone was like, should I relook? I wanted to buy a house. Rates are down. All right, is now my time?
Yeah.
Again, this article was probably written before rates had come back up again.
Yeah, and this, so they say after Fed cuts, more moved out to buy a home, but only the A-class renters moved out to buy a home. The B and C-class renters decreased. So I think it's more flat than the title of that graph would indicate.
Show me the C-class renter who's buying a house.
I know. Well, you're right. A share of the share of move-outs, just on a percentage basis, the share of move-outs moved from, like, let's say around 10 to around 12% for Class A, and for Class B it moved maybe down from 6 to 5 or something like that, and the same thing for Class C. It moved from about
4 to 3.
Yeah, 4 to 3.
But so, like, out of 100 renters at a C-class community, like 3 can afford to buy a home.
That seems like high number. Well, of the people that are moving out. So yeah, who knows? Maybe they're inhering something, or maybe
True. Yeah, they've just been living the thrifty life for.
Yeah, that's right. But so there are that share. I just think that I'm waiting for a compelling piece of evidence. I think that's the way to track it, though, short of having to strip out all of these things that are like the difference between apartment demand and home ownership costs, like trying to figure out all these variables. Just put out a survey and then track that. That'd be super helpful.
According to Cushman Wakefield, at least their portfolio is still no cracks in renter finances, low delinquency. Everyone's pretty healthy, looks like.
Great. Yeah, they're making their payments. They are.
They don't have any metrics on this. That just.
Delinquency is still healthy.
It's just, here's some lines. We don't know what it represents.
That's true. That's got to be some kind of like.
They're reporting on the portfolio that they third party manage. Cushman Wakefield has a property management division.
And that's what I thought. Okay,
third party, and so some of this is probably not an advertisement. But kind of, sort of.
Yeah.
It's data. They like to put data out, but it's also like, hey, look, this is a service we offer and like how good we're doing.
And what I appreciate about it, at least, though, is that that's probably a decent chunk. It's maybe not as big as like a real page, but they're doing their part. They're drawing from their pool of renters as a slice, a representative slice, maybe not, but big enough to be worthwhile. Other things they're talking about, these demand indicators cooling off and entering Q4.
Return of seasonality.
Yeah, seasonal. They do say that the seasonal cool down, it always happens. But this may be less severe than years past. I think that's what I was thinking. I'm kind of hoping, but
I think to me, in my perspective, I mean, it started a little bit earlier at the cool down than it usually should have. On here, looking at their applications, really peaked in June. Maybe kind of June, July. Sometimes it's a little bit later than that, but certainly seasonal effect is in full effect.
Yeah, things are.
We just said we did not get as big of a push up in demand seasonally as usually would, and just hopefully we don't get outsized declines.
Yeah, and going back to like the demand figures that we learned from Newmark, there's every reason to think that that's going to continue moving forward. I'd like to think that these broader demand drivers like household growth and wage growth are a lot more sticky than the finite supply wave that's receding relatively quickly.
Be nice. Yeah. All right. Did you know, Matt, the Federal Reserve cut rates last week?
I know. There's a lot of things that get lost in this shuffle, and I wonder if Jerome Powell was a little testy because he wanted the spotlight last week, and that pesky president got elected. But who knows?
It's almost like we were talking about. It's like, oh my gosh, too much has happened.
Yeah.
Again, like Fed funds, presidential election.
I'm not saying pesky politically. I'm only saying pesky for stealing the spotlight. Okay.
Well, the big thing is, I mean, it was kind of no news. I mean, stay the course. I mean, there was some talk about like, the just some the granular changes in some of the wording of we've made progress instead of further progress.
Yeah.
And he's like, well, we've made the progress. We can't make it any further progress. We've already we've got to the destination. We no longer need to go to the destination.
Okay.
It's like, okay, got it. So right now, steady as she goes.
Yeah.
Continue to slightly reduce Fed funds rate, but being data dependent. The other controversy was some of the questions related to incoming President Trump, maybe pushing back on the Fed and Jerome Powell.
Yeah.
If the incoming president will ask Jerome Powell to resign, Jerome Powell says that he will not resign, will not get into pressure, and legally the president can't do anything about it. I see both sides of the argument. I truly understand the importance of Fed independence. Mm-hmm. I also understand the Fed. I understand they have a charter that was approved by Congress, but it's a private organization and that does fix prices on credit and money. And I don't know if it should come from the president necessarily. Mm-hmm. Some pushback to the Fed of, you're kind of controlling the economy, the world economy, and what's going on over there. That is of interest to me, a little bit of shakeup and shining a light over there. Because we really don't, it's not there's any audit or anything like that.
There's that the idea,
but also I don't want you to break the economy.
Yeah, independence and continuity and stability that kind of seem to go hand in hand. But I do think that if we're talking about presidents influencing the Fed, I think the Fed can also be a pain to the president. They can both be, they can both ruin each other's days if they want to. So I wonder what there's going to be a back and forth between them before we see anything dramatic like a firing or something.
You think anything with crypto is gonna? Beyond deregulation, do you think
that's a really interesting point. Yeah, I
Bitcoin's
wonder.
Bitcoin's at all-time high also.
The Bitcoin is stratospheric. I know Elon Musk has been hanging out at Mar-a-Lago for a long time. I'm sure he's talked about crypto a lot.
Yeah,
I was surprised.
The crypto community really backed Trump because that was the best bet for deregulation. The Democrats really just had no interest.
My pie in the sky thought was what if is Trump going to put Elon head of the government crypto division or something?
So he's with him and Vivek or
they're heading the Doge.
The Doge office. That's going to be. It's going to be entertaining.
Yeah,
it's a high rate to my business. It's a high-risk scenario with potential high reward.
Yeah.
I think there's downside. Mm-hmm. There's obviously downside, but I think that there is upside because we're just going to try. We're going to try some different new things.
Yeah.
We're going to see what happens, and it might not work, and a lot of it could fall flat on its face. But some of the ideas I think are worth trying, and in a business, you've got to just try different things, and sometimes it's not going to work.
I think that if we're talking about deregulating, some of this crypto, or maybe it's going to bleed into other areas of investment, this is probably a healthy time to buyer beware.
Yeah.
They're deregulating, then there may not be as many protections against loss for investors. But if you're educated, hopefully that's not gonna, then you'll be fine. This may be a time. Yes, it's risk on for a lot of different sectors and a lot of different ideas. For sure, it's going to happen. But make sure you know what you're doing.
Yeah. No, I made a LinkedIn post last week, and it was risk on. The sentiment was risk on.
Yeah, I've been thinking about that for sure.
And in the true meaning of now is time to take risk. Mm-hmm. It's you have to get into the market, but that means that there's risk.
Yeah, and that when you were saying that earlier, I was kind of thinking of your post and how this is probably the attitude now. But whereas before, those people that thought the economy was bad before they voted, and they're like, well, I don't want to take a risk in this economy. Now they feel a little bit better. Now they're willing to take that risk. It's mamby-pamby, fancy feeling kind of stuff. But this is what the calculation that people go with. And a risk is a risk. You don't know. So it's largely based on your stance towards things. And there's a lot of reasons to think that a lot of people are going to be moving in that direction anyways. And I don't want to think bandwagon, but this is. You
don't want to be left out.
Yeah.
There's going to be some FOMO for sure.
Yeah, but but in this Fannie Mae article, I just want to go over it a little bit. It does describe a lot of the different contexts to Fed rate cuts and interest rates in general in ways that I haven't covered before. So I thought that was super interesting. It's by Nathaniel Drake, who sometimes I read these things. I'm like, oh, I'm just going to contact him. So I'd love to be able to talk with him on the Great Report. That'd be really fun.
So you did contact him?
Yeah, I haven't heard back from him, but I heard back from a couple other people that I contacted, and they politely said, actually, we have agreements that say
we don't talk to you.
That they cannot, outside of sponsored conferences, they're not allowed to talk. They're like, we'd love to, but we are.
I mean, outside of sponsored conferences, like we have to sponsor a conference.
Well, we would have to sponsor a conference.
Can we just like make one up? Like, I mean, it could be a real one, but like not, just enough.
Yeah. All right.
Window dressing.
Well, we can work on that.
Okay.
But this article is, labor productivity is up, manufacturing is down, services are up, while non-mortgage credit went up by $6 billion. Credit card debt only increased by $1 billion. So it looks like we're not really getting swamped in debt.
I thought all the credit card debt was going to kill everybody, man.
Exactly. I don't think it is. And that's the thing. We debunked that. Yeah, we debunked that. And, we haven't, to our credit, we also have not heard a lot. Like, I think that you'd see so many headlines if that was the case, if credit was an emergency right now, and it really isn't. They do highlight unit labor costs, which I am taking as like a wage growth kind of thing. And they're saying unit rate labor costs remain elevated at 3.4% compared to a year ago, the fastest pace since the end of 2022. And they're saying that as costs at this level have historically added to inflationary pressures, it remains to be seen whether robust productivity gains can be sustained following this wage growth. So the inflationary pressure is high there. That's why I still think that
where AI comes in.
Maybe, yeah, I guess so. I'm on the chopping block every time I hear that.
I've noticed some people get kind of upset when you bring up AI.
Yeah,
because it's like you're talking about my job.
Yeah.
I'm just trying to make funny memes here with AI.
That is going to be really interesting too. That was another thing I wondered is Elon Musk going to be head of government AI? But looks like he's got the Doge thing. But I wonder how.
I don't know how long that'll last.
Yeah. But that's the thing is.
I hope I hope they can find all kinds of stuff to cut.
I know, and they don't, and I wonder what their authority is going to be. Are they just going to like present things that they want other agencies to do? Is teeth?
I think it sounds like a blue ribbon.
A blue ribbon committee.
Commission, and I don't think there's gonna the article I read. Yeah, it's all super early, but there's no funding or.
But regarding those two things like crypto and AI, and I know we're getting a little bit off base, but we are going from a administration that was really taking let's be very careful with this, right? Let's make sure we put on these guardrails, right? I don't think Trump ever said the word guardrail in his life, but we heard a lot of that from Kamala Harris, campaign. But guardrails off. Maybe they're more willing to experiment with cryptocurrency and AI in certain areas of the government. Hey, maybe IRS is AI now. I don't know.
Yeah.
But it'd be interesting to see how that's implemented. Yeah. And I'm a little worried, but not I guess not that worried. Every time AI fails, I always like to tell you, Spencer, that's like part of my job protection. A couple weeks ago, I had it summarize a report, and I was arguing. It's no, this is not. There's nothing in this. I had to be like a third grade English teacher, and it was still getting it wrong. I was happy, yeah. For now.
I'm consistently impressed and disappointed.
Yeah. And I think that's good. That's healthy, right? And that probably means that you're using it. And that's what I need to do that more. This is as a personal note, just to use AI every day and try to have it build its own model of me, so it knows what I'm thinking and stuff like that.
It's not perfect. It just, when it does work, it's really great. Yeah. But then it's just no, this is Yeah. But it's worth doing. Yeah. Some of the agents that are going to be coming out are going to be interesting.
No, I'm super.
And when they learn from you, it's let me just watch you work for the day, and let me just see what I can just do for you.
Yeah. I've always thought my stance with AI is like, you should be a good curator. You should have high standards because it'll give you something, but maybe, but what it gives you is going to be purely on your own ability to say, is this good enough or do I want you to improve it? So like, man, but like the agents, I'm super excited. Like, this could do a lot of heavy lifting for programming, for just little making things so much quicker, writing emails, right? A lot of like data entry. There's lots of boring stuff that could really be replaced.
It probably could. If you could just learn, how you put the newsletter together. You just all right. Here are all the places Matt looks, and this is his process.
Yeah.
And because not that you like new inputs come in, but like, so like you either there's a fork in the road. That means it's like, all right, well, Matt's not, what's Matt going to do? But then it's like, well, Matt's got to make sure that the AI is doing the job, or who's making sure who's making sure that's getting done correctly,
making sure the AI
curating it, and then
doing other stuff.
And there's other stuff to do. It's like, it's like we got a long list. Long list of stuff. So it's like it opens up bandwidth.
Yeah. And then that is a metaphor for labor in general. Like the jobs today are not going to be the jobs tomorrow, and there's always going to be a need for people to do things. And once there stops being a need, then maybe that's paradise. Maybe we get the
post-scarcity.
Yeah, exactly.
One day. But we got it. But the thing with you got to have a lot of stuff for post-scarcity.
Yeah.
And you don't have a lot of stuff, you just take stuff away.
Yep.
Anyway.
Yep.
But more stuff. So you want to move on to this?
Yeah. So
NAHB,
another short take on the Fed. And this is, I really like this because it had this kind of like a bold, really clear answer to this question. What will the terminal rate be? And that's one of the things like, all right, where are we going? How fast are we going to get there? That's like the two biggest questions that I have when it comes to interest rates, specifically Fed funds rate. They're really coming down, not at 3%. 3% is what the dot plot says, what the FOMC official says. NAHB,
but the markets,
NAHB says 3.5 maybe.
Yeah.
More like 3.5.
And I was going to say on the research report, I'm going to make sure that we include not just the dot plot information, but the futures.
Yeah, okay.
Because there is a big divergence in the Fed funds rate pricing in for next year.
Yeah.
Because the Fed hasn't moved off their dot plot, but the market is not pricing in nearly as many rate cuts.
So that's all. I just wanted to put that reminder in. And it was just an interesting reminder of like the pressures of developers and how that's going to impact building, and that's a nice segue into this Real Page article, which I spent a lot of time.
We could have talked about this probably earlier.
I could, I know, but also, I would have got lost on it. We would have.
And again, we're talking about supply again. Some perspective on the 50-year peak in apartment supply. I mean, again, not since the 1974 have we delivered more apartments in the United States. And again, this is in the face of like we've actually had like positive absorption and vacancy rates have declined. That's insane. That underscores how much demand there is in the market. This is a relatively cute article by Kim O'Brien, which I think, but it's like, how long ago is this? This is just underscoring how long it's been since we built so many apartments. Just talking about what was going on.
Think about it, 1974. What do you got?
And she's like, most of us weren't, a lot of us weren't around.
You got your Watergate, Happy Days, Hank Aaron was around, The Godfather Part 2. I put in some musical highlights. Queen, Van Halen, and the Ramones played their first concerts in 1974. The Proto-Punk Visionaries, the Modern Lovers, disbanded that year 2 years before their seminal self-titled album. That's a little color from me. But yeah, 1974, long time ago. You get an idea of that time. I really love the graph, though. That graph is like, I have my notes here, and there are a lot for this graph. Just showing not only the level of the raw number of apartment supply at any given for any given year, but also showing the percentage that was added to supply for that year. So, for instance, that peak of relative peak of 1974, it added a little bit under 700,000 apartments, but supply on percentage basis grew by 5%. Compare that to now, we're adding about, what was the number here? 647,000 for the same, 5% the real page number is 557,000 now. We're only adding 3% to new supply. So there is that raw comparison, and then like there's like eras that I identified just looking at that graph. So you had this era, and I used a little bit of extra data from the Census Bureau to look at multifamily construction. It really peaked, or like this huge wave that they're 1968 basically to 1988 was this elevated supply period, this kind of 20 years where supply was growing between like 3 and 4%, basically around like 3% on average during that time period.
Basically until like the savings and loan crisis, I believe.
So there's this period. And so what it represented to me is like, all right, we've done it before. We had a long period where we were adding just as much now. We're going crazy. We're back. We're doing flips because over this apartment supply. And man, that was just another year, in the 80s or 70s. Yeah. And so you had that period. But then the reason why it feels so weird now is because from 1988 to basically kind of like now, supply was growing only like 1% and 2%. So there are these two periods and what's interesting is we've had a little bit longer of this relatively low supply versus, the supply in the past. Yeah. So I don't know if there's probably demographic reasons too. Like I always connected the 70s as like, all right, the boomers are getting old. Let's build apartments for them. And so that's what's happening in the 70s. Yeah. But still like buildings deteriorate. You have to keep them up. And like the millennials and the Gen Z, those are still like demographic pressures for them. So
now Gen Alpha.
Yeah, maybe not Gen Alpha. I don't know. I don't know how big that Gen our kids
big enough. They're runners. They're like Gen Alpha. They're like what? They're like 18? No, 19?
No, really?
Yeah, Gen Z's like old.
I'm gonna have to
I don't know.
My books. I feel so old now.
Yeah, no. Gen Alpha. They're coming up. I think they're in like college maybe.
Okay.
They're like, but like yeah, Gen Z Gen Z has like jobs.
The U.S. population now and 60% larger.
Gen Zs are going to be my sister-in-law is Gen Z. She's going to be a doctor, like in a year.
No.
Yeah, you're going to have. She has already delivered babies.
Oh, jeez. Great, wonderful. All right, but I want to think about the 70s again.
Go back to the happy days.
Yeah. Oh, I forgot to say that. So 1974. The Fonz was banging on the jukebox. We were banging out apartments. I want to get that in. But also, the U.S. population is nearly 60% larger now than it was in 74. And still, we're adding slightly less apartments than we did way back when. And it's made such an impact on it.
That's an interesting statistic. The ratio of deliveries relative to the population.
Mm-hmm.
That's cannot be underscored.
Another thing I wanted to note here was the figures that you get. And so this is common for a lot of things, whether it's projections or like the actual numbers. So I was looking at CoStar estimates and CoStar figures for deliveries, and they had, it's like 657,000 or something like that. I'm sorry, 683,000. The census had 647,000. RealPage has 557. This is all the year-over-year new supply as of Q3 2024. So I emailed.
And there's been some divergence in some of the numbers on what is actually projected to be delivered.
Exactly, that too. And so that kind of does have an immediate relevance on like, all right, are we past the hump, or do we have another quarter where it's going to get bigger?
Because Yardi was pushing for anticipating more deliveries throughout 2025 and 2026. Whereas RealPage was basically saying that some of those, the buildings that were permitted won't actually be built.
And I saw RealPage, and I was like, I don't know about their projections because they have deliveries falling off by like half in 2025.
Yeah.
And that could happen. I think that there is a very good chance that I think it's more likely than not that we are past the peak of apartment deliveries.
The fact that again that vacancy is loosening, or tightening up a little bit would indicate so.
Yeah. But I was able to email Carl Whitaker. I emailed him late last night because I was working on this. It's like, we'll just see. And I was like, don't take any time out of your day. I know you have an important job. And then he wrote me like this really nice, lengthy response this morning, basically explaining that RealPage does use their own data. They look at apartment, they look at when it's scheduled to complete sometimes, and they'll go with they'll kind of use that information. But they're also taking buildings that are a little bit bigger, like kind of institutional multifamily properties, instead of like. The census will take the category's 5 units or more. And so you can get little tiny buildings that aren't, that you wouldn't traditionally think of as like a multifamily apartment building. So
like a duplex.
So I could definitely see that variance. And I'm actually more willing to see the RealPage number as like a kind of an accurate view of the market than these others. But again, like look at different sources, see if the trajectory is going in the right direction and in these different sources, and that can kind of get you some really actionable insights. Rather than maybe the numbers may be a little shaky here and there, but you'll get where the trends are going for sure.
And then sometimes the most important thing and what you can really discern is the direction of travel in the trend. So it's really good tip.
Yeah. And so my whole point when I was trying to go through this moment of, all right, the 70s were high supply, and then, like the 90s through the 2020s were low supply. Like we're at this moment where housing costs are super high. We had 2 measly years where we added 3% to existing supply. Compare that to like the 10, 20 years in the 70s and 80s. And like we still need more housing in 2024.
Yeah.
That's it. In the multifamily market, we're not going to be building enough apartments to meet that need. And so for multifamily investors specifically, this means higher rent growth. This means better investment prospects. So that's my kind of bottom line. Would probably agree with the Newmark report too. The fundamentals are improving. It's super interesting. It's calm before the storm for the investor activity. That's probably I'll
tell you, man. I keep getting we have investors reaching out to us every day looking to place equity every single day. Not us soliciting people. Yeah, they're reaching out to us. Some of it is existing or newer investors who just did our first deal, look for the next deal. And I take those sentiments as anecdotes in an extrapolate amount to say like, all right, there's some bullish sentiment out there. We got the deals have to be right. I mean, that's we were talking about earlier, is that you can't just go out there and just buy whatever.
That's what I was thinking when you said that. I was like, oh man, if only we had the right deal to make you happy. I really want to make these investors happy, right?
Yeah, we want to do a deal too. But we have to. The market's going to be. It's not going to be an easy market, but I believe that there are incredible opportunities. Just because, like we closed on Solana property we just bought in Indianapolis back in about a month and a half, 2 months ago. We got such a good deal on it, such a great property, great location. Will be some of those opportunities out there, but there's also going to be stuff that's just priced way too high, and there's going to be some suckers. There's going to be some people who are just too overly excited, and they're going to pay up, and they're not going to lose money. They're just not going to make that much money. Maybe they'll do really great. But it's we're seeing light at the end of the tunnel, but like we're not out of the woods yet. Yeah, which is kind of the point you were trying to make.
It's interesting to see, kind of how you and how Gray Capital has changed, like general strategies, and how the market kind of has changed too. So it's going from like value add as like the assumed project of any multifamily syndicator to now like at least like we seem to be going after a little bit nicer properties, and how that correlates with the market and with the interest rates and with maybe materials prices even and expenses. And so like there's lots of things that's changing. I don't know what expense, that's something I haven't talked about, is like expense growth, and that's hopefully not going to be as accelerated in 2024, or in 2025.
Yeah, hopefully not.
Yeah, who knows?
Yeah. Well, this is going to be a great episode. Make sure you subscribe to the Gray Capital YouTube channel. First of all, make sure you get an update to the bell icon. Leave a comment below the video. Let us know what you think. But then hop on over to graycapitalllc.com/report or grayreport.com to sign up for the newsletter. That's really kind of the meat and potatoes. That's where all these articles you will be able to find and more. It's a bi-weekly newsletter. The big one comes out Thursday at 8:30 Eastern Standard. And, we're looking for multifamily deals. Don't have anything right now. But, man, if you want to get on the list so you're, actually can invest before we fill up, and if you're an accredited investor, greatcapitalllc.com. There's a button. You can press it. Learn more. Love to have a conversation with you, see if it's a good fit. Might not be. That's all right.
We'll find a deal for you.
We'll point you in a direction.
Yeah.
Not real estate advice or investing advice. All right. Thank you, everybody. Talk to you next time.